and welcome to this week's Gig Harbor Market Update. My name is Christian. I'm with Windermere. I'm going to tell you the latest real estate news you can use. And we're going to be talking about interest rates this week and why it matters because, well, interest rates have been fluctuating for a while now. But I just want to talk to you about the latest news that just came out from the NAR regarding the high interest rate environment that we're in. So we're going to look at that here in a second. I just want to say, hey, the weather, wow, we got a little respite from the early summer we're having. So it was really nice to have a dark, chill day today. So anyway, that's enough about the weather. Let's talk about real estate. All right, this is the FreddieMac.com. We're gonna be looking at our 30-year fixed rate mortgage. We're now at 6.71%. This is the 15-year. So the green here's the 15. Don't worry about the 15 as much. We're gonna be looking at the blue. And I'm sorry if you're on your cell phone. I don't know if I can make this any bigger. I tried already, but it wasn't quite going along with me. I'm jumping all around, see, it doesn't work. All right, so here we are. We were above 7% at one point, and historically we were at, well, we are currently at about, give or take, what we were at before the Great Recession, the Great Financial Crisis, GFC. So that's where we are, just a little perspective. It seems like we've run up a lot in interest rates, but looking at it just historically since 1972, we're right back where we ought to be. It looks pretty, in terms of lack of a better word, pretty normal. So I think we just got spoiled after the 2008 market crash. They lowered interest rates in order to spur the economy, and of course that took a while, and they just kept interest rates artificially low, especially here during COVID. They tried to make sure that we didn't shut down and enter a depression during COVID. So that's why the Fed was running out of tools here, and so they had to act quickly in order to make sure that inflation doesn't become another issue that they can't tackle. So I think we're 6.71%. But let's look at what the NAR just released. So they have this piece titled, let me zoom in a little bit, mortgage rates near 7%. Oh yeah, this one. Nearly 5.5 million more households are priced out of the housing market today than a year ago, NAR data shows. And I think we were a year ago there was 5%. I think we were, 5%. So just that extra percent, 1.5%, prices out 5.5 million people. That's astronomical. So let's read. The 30-year fixed rate mortgage rose again this week, averaging 6.7 something, right? And forcing more home buyers to recalculate their budget. Mortgage applications are falling, and they're down 31% year over year. So if you're a mortgage lender, it's tough. But economists say mortgage rates are likely to drop in the upcoming weeks, which could help alleviate some of the affordability pressures on home buyers. So that's good news for those who've been biting their nails, hoping that interest rates don't go up any higher. The jump in rates this week was due to a buoyant economy that has prompted the market to price in the likelihood of another Federal Reserve rate hike, says Sam Katter, Freddie Mac's chief economist. Although there has been a steady flow of purchase demand when rates are in the low to mid-6 range, that demand is likely to weaken as rates approach 7%. So you have one camp that says economic news is going to push rates even higher. Now, we're going to get to that second viewpoint here in a second. But let's read a little bit more. So here, again, nearly 5.5 million more households are priced out of the market, says I can't read that. Nadia Evangelou? I'm going to say that's right. Senior economist and director of real estate research at the NAR. Although there are few buyers, more than 1/3 of properties are sold above their list price due to limited inventory, especially in the price points that first-time buyers can afford. Yes, that's very true. I've noticed that was in Gig Harbor when we do have those houses that get priced between $500,000 and $600,000. There's usually multiple offers, and they sell, within the weekend. So I would definitely feel that here as well. So she says she's hopeful mortgage rates will reverse course in the coming weeks. So different viewpoint here. And the NAR is predicting rates to stabilize near 6% in the second half of the year. Evangelou notes that two factors would help rates fall. It's positive progress with the debt ceiling. Okay, that happened already. And the pause on the Federal Reserve's rate hikes. Although these two factors not really affect mortgage rates directly, they affect the economy and eventually mortgage rates. So that's what we have to look forward to, is the Fed saying one thing and then mortgage rates hopefully falling as the outlook on the economy isn't as bleak, I guess. So we're hoping that the Fed will pause rates as they say, hey, we're winning against inflation or unemployment's going up, because they're using unemployment as a metric to seeing if they need to keep raising interest rates. Because I guess they use an old Phillips curve argument that unemployment and inflation are correlated. So the higher the unemployment rate, the lower the inflation is the argument. Yeah, that's clear as mud. All right, it's just for me to understand what this article is trying to say. It's saying that we're expecting another Federal Reserve rate hike, which will undoubtedly impact mortgage rates to go up. But on the other hand, economists say mortgage rates are likely to drop in the coming weeks. Just look at this. This is a year graph. So, I mean, yeah, it's possible that interest rates can drop maybe down to, the low sixes. Fingers crossed, and that could help people get into the homes, especially as we enter the summer and then the fall market, when hopefully inventory will stay on the market a bit longer before it gets snatched up. So hopefully people get into their houses if they've had patience. Yeah, that's basically it. So good news if you're a buyer. Interest rates should come down by a few basis points here, and hopefully the housing market will cool here as it seasonally does. So if you've been patient enough, you'll get it. I want to quickly go through my opinion, which I wrote here in my email. I'm going to read it, and then I'll read a little bit more about this Reuters article, but hang on there. So I wrote, I suspect interest rates will remain high and will only come down in the event of a Fed pivot. So why would the Fed pivot? Well, the market wants, so Wall Street, when I say the market, Wall Street, wants the Fed to pivot because they really liked their low interest rate environment. They got addicted to cheap money, and they're like, please, 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 Fed, lower the interest rates. They'll be super bullish for the economy. And so Wall Street got addicted to cheap money. They were borrowing money, and they were making more money on the money they borrowed, and then they had to pay it back in interest. So they loved it. And I don't think the Fed sees it that way. The Fed is not going to pivot just to give Wall Street more reason to spur on the economy. The Fed is trying to bring down inflation and trying to tamp down the economy. So the only way that I see the Fed pivoting is if they see that we're entering a recession. And that's the only way that they can really fight against it. So if we do enter that recession, the money printer, yes, will go burr again. And why is that? Well, they want businesses to spend money and they want banks to lend. And by that, the economy works and creates jobs. So to avoid entering a depression. Okay, so what I want to talk about is the yield curve, because the yield curve and the fact it's inverted has been an indicator that economists have used to forecast a recession. So let's read this Reuters article. Once again, putting a spotlight on what many investors consider a time-honored recession signal. An inverted yield curve occurs when yields on shorter-dated treasuries rise above those for longer-term ones. It suggests that while investors expect interest rates to rise in the near term, they believe that higher borrowing costs will eventually hurt the economy, forcing the Fed to later ease monetary policy. This phenomenon is closely watched by investors as it has preceded past recessions. Okay, here's shorter dates. Okay. What should the curve look like? The yield curve, which plots the return on all treasury securities, typically slopes upward as the payout increases with the duration. Yields move inversely to prices. A steepening curve typically signals expectations for stronger economic activity, higher inflation, and higher interest rates. A flattening curve means investors expect near-term rate hikes and pessimistic about economic growth further ahead. And then what does it look now? And then let's just see, what does an inverted curve mean? The inversion suggests that while investors expect higher short-term rates, they may be getting nervous about the Fed's ability to control inflation without significantly hurting growth. The Fed has already raised rates by 450 basis points over the last year. The 2 over the 10-year yield curve has inverted 6 to 24 months before each recession since 1955, according to a 2018 report by researchers at the San Francisco Fed. It offered a false signal just once in that time. That research focused on the part of the curve between the 1 and 10-year yields. So, for the last 6 recessions, a recession on average began 6 to 36 months after the yield curve inverted, she said. Before this year, the last time the 2 and 10 part of the, those are the 2-year Treasury and the 10-year Treasury, part of the curve inverted was in 2019. The following year, the United States entered recession, albeit one caused by the pandemic. And what does it mean for the real world? When short-term rates increase, U.S. banks raise benchmark rates for a wide range of consumer and commercial loans, including small business loans and credit cards, making borrowing more costly for consumers. Mortgage rates also rise. When the yield curve steepens, banks can borrow at lower rates and lend at higher rates. When the curve is flatter, their margins are squeezed, which may deter lending. So, all right, with that said, that's it for the week. And enjoy the weekend. And we'll see you next week.